Hello, I'm Nick Huntington Klein. I'm going to be talking about how firms in competitive markets make decisions about how much to produce. So the first thing we need to know, we are in a competitive market here, so the firm has no control over the price that it is selling something for. It can't control the price. The market itself is going to set the price based on the aggregate, the overall market supply curve and the overall market demand curve. We're just going to sort of take that price. We're going to be price takers and just see what it is and respond to it as appropriate. So from there, we can figure out how to maximize our profit. That is our goal as the firm in the competitive market. We want to maximize our profit by looking at the price and deciding how much we want to produce, what's going to maximize our profit. Of course, we want to produce until marginal cost equals marginal benefit. That's the golden rule. That's always going to be the decision-making rule for how much of something to do. We want to set marginal cost equal to marginal benefit. Okay, that's our starting point. So how do we do that? How do we set marginal cost equal to marginal benefit? So if we think about what marginal cost and marginal benefit actually are from a producer's point of view, marginal benefit is the price, right? The price is the marginal benefit, because what do you get out of selling another unit of good? Well, you get paid the price. So the marginal benefit for you is the price. What's the marginal cost? Well, the marginal cost is whatever your costs are. So you would look at what your costs are and what your marginal costs are for each individual unit that you make, and you're going to keep making units until your marginal cost equals the price. Why is that? Well, imagine your marginal cost was lower than the price. If your marginal cost was lower than the price, then you'd say, hold on a minute, I could make some more units and I'd still make money off of them because I'd get paid the price and I'd have to give up my marginal cost, but the price is higher than the marginal cost, so I'd make money. So I shouldn't stop there. I should keep going until I hit the point where marginal cost equals the price, because at that point, I can't make any more money than that. If I keep going beyond that, then my marginal cost would be above the price, and I'd be making units that I would be losing money on, which I don't want to do. So let's think about that. So we want to set price equal to marginal cost. That's how we can maximize our profit. And I can tell you already what some of the steps we're going to take are. And these are going to be the sort of steps we're going to follow when we're thinking about maximizing our profit. So the first step that we're going to follow, as I mentioned, we're going to set price equal to marginal cost. This is going to allow us to solve for an optimal quantity that's going to maximize our profits. Okay? By setting price equal to marginal cost, the marginal cost function is going to be a function of quantity. And if we are given the price, we can then solve that out for whatever the quantity is. Then, once we know what our quantity is, we want to figure out, well, what is our profit? How much profit are we actually making with this quantity and this price? And we're going to do this using this profit function right here. Price equals quantity times price minus average cost. And the reason why I'm going to use that particular format is because it graphs out very nicely, as we'll see in a moment. But basically, all we need to do is take our quantity, take our price, take our average cost, plug those in. We already know what the quantity is. We solve for that in step 1. Now we already know what the price is. We were given the price because the price was given to us by the market. So we just need to figure out what the average cost is. So first we take our quantity, plug it into our average cost function. Average cost is just the total costs, your total cost function, divided by Q. It's the average of your costs over all the units that you produced. Right? Total cost divided by Q. We're averaging over the Q units that we have. So we plug that in, get average cost as a number, plug all 3 of those into our profit function, and that gives us our profit. Before we run through this algebraically, let's run through it graphically. Let's see what this looks like. So first of all, let's see what the curves look like for a firm in a competitive market. So we're going to draw out their cost curves. We have price up here, we have quantity down here, and there's 3 curves that we want to have on here. The first one is marginal cost. It shows us what the marginal cost of production is. I like to draw it as this little J shape, because it sort of represents how you have some returns to scale at those very low amounts, and then it sort of swoops up. But now you might be thinking, hold on, aren't there returns to scale generally? As we get bigger and bigger, won't our costs go down? Isn't that the whole thing? Well, keep in mind, this is a short run marginal cost curve. So this is basically saying, imagine that you're a shirt maker. Right? You screen press shirts in your garage, and you make like 1 a day. Now, if you were to grow into a giant, enormous screen printing operation with millions and millions of shirts over a long period of time, then yeah, your costs would go down quite a bit. And so as quantity went up, your total cost would go down, or your marginal cost would go down. However, that's not what we're talking about. We're not talking about growing to a huge size over time. We're talking about right now, basically based on the materials and machines you have available to you at this exact moment, what are your marginal costs? So if in your little screen printing operation in your garage where you make 1 a day, somebody came in and said, hey, I want to buy 5,000 shirts tomorrow, right? That's the kind of thing that this line is describing. Okay, so you have this upward sloping marginal cost curve. I'm going to label it marginal cost. Then I'm going to put on an average cost curve. An average cost curve is going to have this sort of cup shape, and it's going to intersect with marginal cost at its very bottom, at the very sort of bottom of the cup. Why is that? Marginal cost is the next unit's cost. Average cost is the average of all the units' costs. So if you think about, like, imagine the height of everybody in a room, right? Somebody walks in the room, that's the marginal cost. If that is below the average, as it is like down here, then the average is going to come down. So we have a downward sloping average cost. People keep coming in, they keep being below average, so the average keeps going down and down and down and down until they meet, and then immediately the next person who comes in is above average, and so the average starts going up and up and up again. So it's always going to intersect at the minimum point of average cost. Okay, that's the second line. Third line is demand. Now, normally when we draw a demand curve, it slopes downwards, right? Because demand slopes down. As the price goes up, people want to buy less. But that's at the market level, and we're only at the individual firm level. At the individual firm, they have no control over the price. No matter how many units they sell, the price is always going to be the same. So from their point of view, at all quantities, the price is exactly the same. And so from their point of view, demand is a flat line. So this is demand. You could also think of it as the price. Okay, so those are the three lines. Now let's follow our 3 steps. So step number 1, set price equal to marginal cost and get quantity out of it. So we're going to follow our price curve along until we hit marginal cost. By the way, setting 2 things equal to each other in algebra is the same thing as graphically finding an intersection between 2 lines. So we have the price line, we have the marginal cost line. If we want to set marginal cost and price equal to each other, we just look for where the lines cross, and here it is. And then that will give us a quantity, Q star. Next, we're going to plug our average cost into the average cost function to get an average cost as a number. So we take this quantity, we follow it along until we hit average cost. Again, looking for the intersection of the line. Follow that along. Notice it's not quite at the point where marginal cost and average cost cross, because that was the minimum. It goes slightly above it. So here's average cost as a line. Here was price. Next, we're going to do the profit function, which is quantity times price minus average cost. Now, where's that come from? Well, that is the number of units you sell, quantity, times the average amount of profit you make on each of them, price minus average cost, right? If I sell a unit, I get paid the price. On average, I spent the average cost to get there. So on average, I'm making price minus average cost profit per unit. So add that up over all the units, and I get Q times P minus AC. And graphically, what this gets me is a box. It's a box. It's 2 numbers multiplied together, quantity times price minus average cost. 2 numbers multiplied together in a graph, that is a rectangle. So we have this rectangle here. Here is the distance between price and average cost right there. Here is from 0 to Q. So we have a width of Q. We have a height of price minus average cost. And we can shade everything in. This whole rectangular area in here, rectangular, is our profit. Okay, there we have it. Now we've drawn a graph of our profit. Let's do this algebraically as well, following the exact same steps. So let's say that we have a price of 20, a marginal cost of 2Q, and our total cost function is 6Q plus 10. So if we make 10 units, then the total cost that we'll have to expend for that is 6 times 10, which is 60, plus 10 is 70. So it'll cost us $70 to make 10 units in total. Okay, so step number 1, set price equal to marginal cost. So that is 20 equals 2Q. Divide both sides by 2, we get that 10 is Q star. So we're going to make 10 units to maximize our profits. Step 2, we'll plug that into our average cost function. We don't have an average cost function, but we can get one by just taking total cost and dividing it by Q. So average cost is total cost divided by Q, which is, don't forget to put everything in parentheses, 6Q plus 10 over Q, which is 6Q over Q becomes 6. 10 over Q becomes 10 over Q. Then we can plug in our 10, so we get 6 plus 10 over 10, or 6 plus 1, which is 7. So our average cost is 7. On average, we pay 7 to make these units. Next, we can plug all 3 of these things into our profit function. So profit is quantity times price minus average cost. Quantity is 10 times price, which was 20, minus our average cost, which was 7. So we get 10 times 20 minus 7, which is 13, 130. So we're going to make 130 of profit here. One very last thing that I want to do is just show you where exactly that price comes from, because I've just given you the price here, but remember, this is coming from the market itself. So we can envision where this price is coming from by drawing two graphs. Over here on the left, we have a regular supply and demand curve for a market. Over here on the right, we have the individual firm's costs. So we have the marginal cost, we have the average cost, which intersects at the bottom there. So where's that price coming from? Well, we get an equilibrium price from the market. We follow that over, and that gives us our demand curve over here on the right. That's where that price comes from. If you don't have the price, you could get it from the supply and demand curves. All right, those are the basics of competitive production, how a firm in a competitive market chooses how much it's going to produce so as to maximize its profits. And of course, it's trying to chase marginal benefit equals marginal cost, which here translates to price equals marginal cost, which we can see on the graph, we can see algebraically, we can follow our 3 simple steps to maximize profits and figure out what those profits are. Thank you.